Hey everyone, and welcome to another deep dive. Have you ever looked at the stock market and wondered, could I predict this?
It's a question a lot of us have grappled with, that's for sure.
And we've got some fascinating articles that dive right into that very question. They're all about the psychology of investing. Why do we tend to think we can predict the market, even when it feels like a shot in the dark?
That's the million-dollar question, isn't it?
Well, let's see if these sources can shed some light on the cognitive biases and illusions that might be tripping us up.
You know, it's fascinating. There's this deep-seated human desire for control, especially when it comes to our finances.
Absolutely. We want to feel like we're in the driver's seat, calling the shots.
Right. And in a world that often feels uncertain, we crave that feeling of predictability. But here's the thing. Markets thrive on uncertainty. And that's where things get really interesting. Because we humans, well, we aren't always wired to deal with uncertainty gracefully.
Okay, I am intrigued. Tell me more.
Our brains, as incredible as they are, sometimes lead us astray. These little detours, those systematic errors in our thinking that influence our decisions.
Yeah, I think I've heard of this. They're called cognitive biases, right?
You got it. Cognitive biases. These sneaky mental shortcuts can trip us up, even when we think we're being perfectly rational.
So it's like our brains are playing tricks on us and we don't even realize it?
Exactly. And these biases can really throw a wrench in our efforts to make sound investment decisions.
Okay, I'm hooked. What's a real-world example of this cognitive bias thing in action? I need to understand this better.
Picture this. You're driving home in your brand new car. It's that sleek silver model you've had your eye on for months. Finally took the plunge.
Okay, I'm feeling good just thinking about it.
Suddenly, you start seeing that very same car everywhere you go, at every stoplight, in every parking lot.
Oh, I know that feeling. I swear, it's like everyone suddenly had the same idea as you.
But here's the thing. It's unlikely there's been a sudden surge in sales for that specific make and model.
So what's going on?
It's your brain zeroing in on what is suddenly relevant to you. That new car is on your mind, and your brain is highlighting anything related to it.
Oh, so it's not that everyone suddenly bought the same car.
Yeah.
It's my brain playing tricks.
Precisely. And that, my friend, is confirmation bias in action. We seek out information that reinforces our existing beliefs.
And this plays out in investing too.
Big time. Let's say you buy a stock and it does well. Confirmation bias kicks in, making you more likely to remember that win, that feeling of being a savvy investor.
So far, so good.
Right. But what about the times when a stock pick doesn't pan out, the ones that flopped? Are those memories as vivid?
I mean, probably not as much as the wins, to be honest.
Exactly. Our brains tend to highlight the positive and downplay the negative.
It's like when you go on vacation and you remember those amazing meals, but completely forget about that awful flight delay. Out of sight, out of mind, right?
That's a perfect example.
Yeah.
Our brains are wired to prioritize positive memories. It's an evolutionary advantage, helping us stay optimistic and all that.
Okay, that makes sense. But how does that help or hurt us when it comes to investing?
Well, imagine selectively remembering only those winning investments. It creates this warped perception of our actual track record, making us think we're better at picking stocks than we might actually be.
So not only are we more likely to remember winning investments thanks to confirmation bias, but selective memory makes it even harder to recall the losses. And on top of all that, our brains are wired to make these errors. It's like we're fighting a losing battle against our own biology.
You're getting it. It's not just about a lack of discipline or financial knowledge. There's actual neuroscience at play here.
Mind blown.
It's true. Nobel Prize winner Daniel Kahneman explores this in his book, Thinking Fast and Slow. He talks about these two systems of thinking we all have, one that's fast, intuitive, and prone to biases, and the other that's slower, more deliberate, analytical.
So with investing, are you saying we need to slow down our thinking?
Exactly. We often let that fast, emotion-driven system take the reins when we should be engaging the slower, more rational one, especially when dealing with something as complex as the financial market.
And I imagine that's where overconfidence comes into play.
Man.
We get so caught up in those quick wins, we start to believe we've got some kind of market-predicting superpower.
Precisely. That tendency to remember wins more easily, to downplay the losses, it feeds into this idea that we're amazing at picking stocks, even if the data doesn't necessarily back that up.
And suddenly we're throwing money at every hot stock tip that comes our way. Certain we're on the fast track to riches. I think we've all been there at some point, haven't we?
More common than you might think. But here's the kicker. It's not just a hunch. There's compelling research to support this idea that overconfidence can lead to poor investment decisions.
Really? Do tell.
There's a fascinating study by Barber and Odine. They analyzed trading records of thousands of investors. And guess what they found?
I'm on the edge of my seat.
The investors who were most confident, the ones convinced they could beat the market, they actually traded more frequently.
Which, in theory, could mean more opportunities to win big, right?
You'd think so, but here's the catch. Those frequent traders often ended up with worse returns compared to those who took a more measured approach.
So the very act of believing you can outsmart the market might be what leads to underperformance.
That's wild. And it's even more interesting. These articles mention that even professional fund managers, the people who do this for a living,
I know where you're going with this.
even they struggle to consistently outperform the market. If those seasoned pros with all their fancy algorithms and data can't crack the code, what hope do the rest of us have? It's humbling, isn't it? It really is. And, a big part of it is that even with all the sophisticated tools and years of experience, they're still human. Those cognitive biases we've been talking about, they don't discriminate.
No one is immune to the allure of believing they've got the magic touch when it comes to the market.
Not even the experts. We all fall prey to the illusion of control at some point.
So where do we go from here? If even seasoned pros aren't immune to these cognitive traps, what does that mean for the rest of us who are just trying to navigate this complex world of investing?
That is the million-dollar question, isn't it? The good news is, simply being aware of these biases is a huge step in the right direction. Knowledge is power, after all.
So it's not about magically developing ESP and predicting the market's every move.
Not quite. Though wouldn't that be nice? It's about recognizing that no one, and I mean no one, has a crystal ball when it comes to investing. The future, especially in the financial markets, is inherently uncertain.
Okay, that's a lot to unpack. So if we accept that we can't predict the market with absolute certainty, what then? How do we make smart, informed decisions in a system that often feels unpredictable and, frankly, a bit chaotic?
Excellent question, and it leads us to some practical advice you can start implementing today. The key: focus on what can be controlled. Your own behavior, your own investment strategy. We'll dive into all that after a quick break.
So before the break, we were talking about how important it is to focus on what we can control when it comes to investing. What does that look like in practice? Where do we even begin?
It all starts with a healthy dose of, humility. We have to accept that markets are inherently unpredictable, and that's okay. We don't need to have all the answers to be successful investors.
Humility. Okay, got it. It's about recognizing that we're not infallible market wizards.
Right.
What comes after humility?
Discipline. It's like having a roadmap for your financial journey, especially when the markets feel more like a roller coaster than a leisurely drive.
So no more making those impulsive stock purchases based on a hot tip from a friend or a catchy headline.
Exactly. Remember those two systems of thinking we talked about? Discipline means hitting the brakes, engaging that slower, more rational system, even when FOMO is whispering in your ear.
Easier said than done, right? Especially when you see others seemingly making a killing from those quick decisions. It's tempting to throw caution to the wind.
Absolutely. And that's why diversification is so crucial. Remember that old saying, don't put all your eggs in one basket?
Classic advice. But how does that apply to investing, specifically?
Well, let's say you've become a little too confident about a particular company or sector. You pour a significant chunk of your savings into it, only to have it, not pan out quite as you'd hoped.
Ouch, that's gotta hurt.
It happens. But here's where diversification comes in. By spreading your investments across different asset classes, sectors, you're essentially creating a safety net.
So even if one investment goes south, you're not putting all your financial eggs in one basket. You're protected by other investments that might be performing better.
Precisely. Diversification is about managing risk, cushioning the blow for those times when inevitably our predictions don't quite line up with reality.
That makes a lot of sense.
Yeah.
Okay, so we've got humility, we're staying disciplined, and we're diversifying our investments. What else can we do to keep those sneaky cognitive biases from sabotaging our best efforts? What's the final piece of this puzzle?
Objective analysis. It's about basing our investment decisions on solid data, not just our gut feelings, which can be heavily influenced by those biases we've been discussing.
So taking a step back from those initial, often emotional reactions and really looking at the information objectively. Easier said than done, I imagine.
It definitely takes conscious effort. Remember confirmation bias. We have to actively seek out diverse perspectives, challenge our own assumptions, even if it feels a little uncomfortable.
So no more just skimming headlines that confirm what we already believe. We have to dig deeper, consider different viewpoints.
Exactly. We need to approach information with a critical eye, questioning everything, and most importantly, being open to the possibility that we might be wrong.
That can be a tough pill to swallow sometimes. So how do we become more objective in our analysis? Any practical tips?
Absolutely. Start by diversifying your sources of information. Don't rely on just one news outlet or financial guru. Look for different perspectives, even opposing ones. Challenge yourself to understand the reasoning behind those differing viewpoints, even if you don't agree with them.
So it's about stepping outside our echo chambers and being open to new information, even if it challenges our preconceived notions.
Precisely. And it's an ongoing process, not a one-time fix. We're all works in progress, constantly learning and refining our approach to decision-making.
This has been so insightful. It's amazing how much of investing is about understanding ourselves, our tendencies, our weaknesses, as much as it is about understanding the market.
It's true. The more self-aware we are, the better equipped we are to navigate not just the financial markets, but all aspects of life.
That's a powerful thought. So it's about more than just picking stocks. It's about cultivating a mindset of self-awareness, of recognizing those mental shortcuts our brains take, and learning to navigate them more effectively.
Exactly. And the best part is, these skills, this awareness we're cultivating, it extends far beyond the realm of investing. These are fundamental principles for making sound decisions in all areas of life.
Now you're speaking my language. So tell me, how else can we apply these principles outside the world of finance? Give us some real-world examples.
Well, let's think about how confirmation bias might show up in our relationships, for example. Let's think about how confirmation bias might show up in our relationships, for example. We might gravitate towards people who reinforce our existing worldview, even if it's not entirely accurate or healthy for us.
Makes sense. It's easier to be around people who agree with us, who validate our opinions, even if those opinions aren't serving us well.
Exactly. Or how about the illusion of control in our careers? We might overestimate our ability to influence outcomes, leading us to take on more than we can handle or to make rash decisions.
Oh, I've been there.
Yeah.
Thinking you can control everything, only to realize you were in over your head.
It happens to the best of us. But by recognizing these patterns, these tendencies we all have, we can start to make more conscious, more intentional choices.
So it's really about stepping back, examining our thought processes, and asking ourselves, why am I drawn to this particular decision? Is it based on solid reasoning, or am I letting my biases cloud my judgment?
Exactly. It's about bringing awareness to those automatic thoughts and challenging ourselves to see the bigger picture.
This has been such an eye-opening conversation. I feel like I'm walking away with a whole new perspective, not just about investing, but about decision-making in general.
That's what we want. Because remember, these concepts we've been discussing, humility, discipline, diversification, objective analysis, they're not just financial tools.
They're life skills.
Exactly. They're tools for navigating the complexities of life, for making more thoughtful, more informed decisions in all areas.
So as we wrap up this incredible deep dive into the psychology of investing and beyond, what's the one big takeaway you hope our listeners walk away with today? If they could only remember one thing from this entire conversation, what would it be?
Self-awareness is paramount. It's the foundation for making sound decisions, for living a more intentional and fulfilling life. The more we understand our own cognitive biases, those mental shortcuts our brains take, the better equipped we are to navigate the world around us.
It's about understanding that our brains, as amazing as they are, aren't perfect. We all have these built-in biases. But by being aware of them, by shining a light on those patterns in our own thinking, we can start to counteract those tendencies. We can start to make more conscious, intentional choices that align with our values and our goals.
Beautifully said. It's a journey of continuous learning and self-discovery. And remember, you don't have to have it all figured out to start this journey. Just start by paying attention to your thoughts, to your decision-making process. Ask yourself why you're drawn to certain choices. Be open to challenging your own assumptions. That's where real growth and insight begin.
Such wise words. A huge thank you to our expert for sharing this invaluable knowledge with us today. It's been an absolute pleasure. And to you, our incredible listeners, thank you for joining us on this journey of exploration and self-discovery. Remember, the journey to becoming a more savvy investor starts with understanding yourself. Until next time, keep those minds curious and, as always, happy investing.